Thank you for your interest in MacroWatch. I'm Richard Duncan. In this video, I'd like to tell you about the ideas behind MacroWatch and to show you what you can expect if you join. I believe the economy no longer works the way it did in the past. Everything changed when the United States stopped backing dollars with gold in 1968. After that, there were no longer any constraints on how much credit could be created, and credit absolutely exploded. In this chart, you can see total credit or total debt in the US going back to 1952. Notice that it first went through $1 trillion in 1964. Then, over the next 43 years, it expanded 50 times to $50 trillion. That explosion of credit fueled global prosperity for decades, but it also created the greatest global credit bubble in history. And in 2008, when the Americans could no longer afford to repay that debt, credit started to contract, and the global economy came very close to collapsing into a new Great Depression. That didn't happen because the US government and governments all around the world responded with trillions of dollars of fiat money creation and fiscal budget deficits. That stimulus kept the global bubble inflated, but it didn't fix the underlying cause of the crisis, which is that there is far too much debt relative to income in the world. That means that without ongoing large-scale government stimulus, the global economic bubble will deflate again, and the world economy will slide back toward depression. So what everyone needs to understand is that now credit growth drives economic growth. Liquidity determines whether asset prices move up or down, and the government attempts to control both credit growth and liquidity to make sure that the economy doesn't collapse. Therefore, MacroWatch analyzes trends in credit growth, liquidity, and government policy to anticipate their impact on economic growth and the financial markets. What I've found is that if credit in the United States grows by less than 2%, adjusted for inflation, the US economy falls into recession. So what you have on this chart is total credit and GDP growth in the United States going back to 1952. The red bar shows GDP growth, and the blue bar shows credit growth adjusted for inflation. So notice anytime that the blue bar grows by less than 2%, the US goes into recession. And it doesn't recover until there's another very large surge of credit expansion, as there was in the early 1980s under President Reagan. So since 2008, credit hasn't been growing by 2%. And that has made quantitative easing necessary. The Fed has been driving the economy by printing money and pushing up asset prices in order to make the economy grow. So I regularly forecast credit growth by sector to see if the economy will ever return to self-sustaining growth. And that's what we see on this chart. The 5 largest sectors of the economy in terms of their level of debt projected out to 2016. This is the household sector, the government sector, the government-sponsored enterprises, Fannie Mae and Freddie Mac, the corporate sector, and the private sector issuers of asset-backed securities. Right, and what this shows us is that credit growth is not going to begin growing rapidly enough to drive the economy anytime within the foreseeable future. We would need something like 5 to 6% credit growth a year in order to return to the kinds of pre-crisis economic growth rates we used to be accustomed to. And we're not going to have anywhere near that level of credit growth. So that suggests the Fed is going to have to continue driving the economy with additional rounds of quantitative easing. In this chart, we have household sector net worth. This has now been pushed up to $85 trillion. It's increased by $30 trillion since 2009, a 55% increase. That has happened because the Fed printed nearly $4 trillion and pumped that money into the financial markets, pushing up the stock market and the housing market, creating a wealth effect that allowed the Americans to keep spending and the US economy to keep growing, even though credit growth was weak and wages were stagnant. So I also regularly forecast the level of liquidity in the economy by comparing the amount of money the central banks are creating with the amount of money the government will have to borrow to fund its budget deficits. This liquidity gauge is very helpful in anticipating whether asset prices are going to go up or go down. Here's what the liquidity gauge looks like. When there is excess liquidity, asset prices tend to go up. And when there is an inadequate liquidity or a liquidity drain, asset prices tend to fall. So you can see in the year 2000, there was a record level of excess liquidity, and that's when we had the NASDAQ bubble. And again, in 2006, we had near record levels of excess liquidity, and we had the property bubble. But in 2008, when there was a very serious liquidity drain, the US economy went into crisis and the stock market crashed. So the objective of MacroWatch is to build a comprehensive framework that teaches MacroWatch members how the economy really works today. Credit growth and liquidity are at the core of that framework. Since MacroWatch was launched in October 2013, I've uploaded more than 16 hours of video content onto the MacroWatch website. Here are some of the subjects those videos have addressed: global deflation, what drives currencies, China's economic crisis, Austrian economics, right and wrong, the Fed and its challenges, treacherous markets ahead, the household sector's balance sheet, analyzing the world's 5 largest central banks, the outlook for global liquidity, Japan's very serious challenges, how capital grows, the European Central Bank's quantitative easing, how the Fed intends to hike interest rates, the prospects for asset prices, the banks, the government-sponsored enterprises, unsustainable wealth, global recession, monetary and fiscal austerity, and regular updates on the US economy. New MacroWatch members can begin watching these videos immediately. There are also 2 video courses: The Global Economic Crisis Explained and How the Economy Really Works. These courses, which are both roughly 2 hours long, serve as an introduction to all the MacroWatch videos that follow. I upload a new MacroWatch video approximately every 2 weeks. All the videos are in the form of PowerPoint presentations similar to this one. Most are 15 to 20 minutes long and contain 2 or 3 dozen downloadable charts. So that's it. I hope you'll consider joining MacroWatch. If you do, I believe you'll have a much better, more realistic understanding of how the economy works and about the forces driving the financial markets today. Thank you, and good luck. The global economic crisis is far from over.